I am glad to introduce Jon Gregory, xVA expert during the Risk Management and Trading Conference 2023. Welcome, Jon.
Hi, nice to be here.
Well, first of all, as a counterparty risk expert, how do you see the evolution on analysis of counterparty risk since the banking crisis from 2008?
Well, the first thing to say is everything has changed. So we can really talk about before 2008 and post 2008. And there are so many things that are just completely different now. So for example, if you take, say, the LIBOR transition, which has been a long transition, but really started in 2008 with the sort of realization that LIBOR was a difficult rate in a number of ways, whether that be just practical or theoretical. And then we've been on a very long journey since, to the point now where the LIBOR transition is complete in some currencies and not so much in others, but at least we're towards the end of that. But obviously that's a process of 15 years where that's happened. And I could talk about many other things for which the same thing has happened. We sort of realized the world changed in 2008. Regulators, of course, realized that things were very different and that they were going to implement a number of things that hadn't been there before, or they were going to be more conservative on things that had been there before. And then there has been a very gradual change towards that way. And when I come here, one of the other difficult things is, of course, there are many banks in the world, and you can have a very large global player with an enormous balance sheet and an enormous economy of scale. And spending a lot of money on counterparty risk is fine and is natural. And then you can have a smaller but still global bank, and then you can have a regional bank. And it's harder, and I think this has come up in other discussions in the conference, it's harder to be the smaller regional player maybe, because you can't do everything with the same economy of scale. So then the problem is, well, can I do everything I would like to do, but without spending maybe the amount of money that I would otherwise have to spend?
Okay, and since 2008, many varieties of counterparty risk have emerged. What's the difference between all of them, or how do they make sense?
Okay, so I think really there are, before you would talk about the different terms, there are just the different costs themselves. So there's the cost of credit risk, there is the cost of funding, there is the cost of capital. And then this tends to get associated to the different terms, CVA, FVA, and so on. Again, we went on a sort of process of discovery where it wasn't until a few years ago where probably everything had been discussed. Everything had been integrated into the framework, at least conceptually. So that leaves us with credit risk, funding, the impact of collateral, capital, and also often separately initial margin is talked about, and they give rise to CVA, FVA, KVA, CVA, MVA. They've gone at different rates. They're not really mutually exclusive, and all the time we're learning more about maybe how they should fit together, or whether you should have more emphasis here or more emphasis there. And for a long time, I think it's been a sort of moving target in the sense of we do more work, but the target is getting further away, and that we discover more that we need to be able to do. Maybe in recent times we're getting a bit closer, but it's still an enormously complex space. And what I tend to say when I'm teaching on this is this would be something you would never decide to do if you had the choice. It's just too complex. But it exists. You have to deal with it. The only option otherwise would be to say we can't have a derivatives market, which of course no one is going to say. But if you want to have a large derivatives market, xVA is one of the things which is a natural byproduct of that, and you have to deal with it as best you can.
Okay, so finally, given the market's conditions, could we see another counterparty crisis nowadays?
For sure, because if I look at just even forgetting about just purely counterparty risk, you look at the risks a bank faces, the traditional risks, market, credit, liquidity, operational, and then some of the newer things, including climate and so on. Where we have problems it's always often a subtle interplay. It's not always a very simple case of maybe Silicon Valley Bank is an example where this is not true in terms of you can boil it down to something quite simple. Often it's a fairly unpleasant sort of interaction between things, which is often hard to predict. So liquidity risk may be your problem that may cause your demise, but it may start with credit risk and counterparty risk, which creates losses, which gives rise to that liquidity problem. And banks are still fragile to certain events. And so I'm afraid absolutely this could happen. And even though, for example, capital ratios have increased substantially since 2008, there are still arguments they should be still much higher. And the balance is, if you create a situation where banks could never fail, then the economic benefit of banking will be very poor. You know, we want to have a good economic benefit from banks, and that unfortunately means we need to be in a situation where they potentially can fail. And so, yes, I'm afraid it can happen again.
But do you think now there's more consciousness about the counterparty risks to avoid them?
I think certainly in an area like counterparty risk, and maybe I'm a bit biased, I think there is a much better understanding, which is why I start mentioning things like liquidity or operational risk in terms of possible failures. So I would see it as we've got a lot better in certain areas, and maybe there are areas like market risk, credit risk, counterparty credit risk, where lessons have been learned and the industry is in a better place than it was 20 years ago. But then that leaves the areas where maybe just by necessity we don't have as much understanding of possible problems, operational and liquidity risks, and then the new things that come along that we weren't even thinking about in 2008, like climate risk, which could be the problems that arise in the future. And then the fact that everything can be interconnected. So climate problems may cause counterparty defaults, and counterparty defaults may lead to liquidity problems. That's the sort of interplay I think we always have to be worried about.
Of course, that's why we need to talk with experts like you and have these workshops where you give the overview of this, of the market, and of also the counterparty risks. So thank you very much for your time, and see you in the next interview of RiskMathics.
Thank you.